Okay, so take a look at this market for the previous entry that was placed, or the previous analysis that was done. Remember again the places to first, when the market gets to 61.8 for the first time, you buy, and that played out well here. And then the next place to sell after 161.8 is broken is 261.8, and you can see the market got to 261.8 and sold down. And then remember, the first entry was to be divided into 24 period, and the first period, which is the first candle that begins the period, is divided into two halves based on the opening price and the closing price to determine the average price. And to record the average price, Fibonacci retracement tool was used. Then to get the 2 points of the Fibonacci retracement tool, where the market is bullish, the Fibonacci retracement will be bearish, so 0.2 will be 100 pips below the average price, and that was what was done. So looking at the chart here, you could see where the average price was at 24855, and then this was 100 pips below it, 24755. And now look at how the market played out. First time the market engaged 61.8 retracement and went up, corresponding with the entry plan. First time the market moved from the average price, it went to 161.8 and came down, then tested 61.8 and went up, broke the 161.8, and later came down again to retest 61.8, went up, then encountered 261.8. All these are levels for entry. So far there were 3 opportunities for entry. First, sell at 161.8. Second, buy at 61.8. Third, you would have sold here, but remember, it's always the first time. So 1, 2, and then third time engaging 261.8, sell. And now you can see that it was after engaging 261.8. Of course, this period ended. If you calculate 24 pips, 24 periods here, you see when it ended. So using the vertical line to measure that, you could see when this period ended. So let's adjust that to 24 candles, so that's 26, so less 2. So when the period ended, of course the market had not come to engage the 0 level, which is 100 pips below the average price. Now after engaging 261.8, which happened in the next period, the same way in this other period, it was the 261.8 level that happened in the new period here of the previous period. Same here also, 261.8 happened in the new period, which of course if we follow the plan, you will see that this is the new 161.8. And then it was after engaging 261.8 that the market came down again, broke the 100 level of the previous level or the previous period, and then engaged 0 level. After engaging 0 level, it went again to attempt 161.8, rejected, and back to 0. Now looking at what has happened so far, you can see that the market has finally now broken 0, and this period ended. So let's see when this period ended. Now this is how to avoid being scammed by the market, knowing where to take your entry, the best spot for your entry. So this is 25, so we'll make it less 1 to calculate the periods correctly. Less 1. So Now we have not done adjustment of the Fibonacci retracement tool for each of this period and see what's happening. Now again, the market is becoming bearish, so which means that if we are readjusting our Fibonacci retracement tool, once we see the market becoming bearish, we'll begin to project our second point to 100 pips above the average price of the first period. So now remember again that the entry levels are 61.8 for the first time. If it is in a bullish market, you buy. 161.8 for the first time. If it is in a bullish market, you sell. And then 261.8 for the first time. If it is in a bullish market again, you sell. So that is it. And then always do new period checks so that you adjust your Fibonacci retracement tool to measure and record the average price and extend the average price by 100 pips, which is a circle of retracement, and that is what is called the expansion move. So you can use this method to find the expansion move of the market and also know the trend move of the market. The trend move is after 100. When the market expands from the average price, you have the trend beginning at the end of expansion. Now expansion is expected to earn 100 pips from the average price. 100 pips from the average price the market is expected to earn, or 61.8. Instead of trying to count 100 pips, you can count 61.8 level. So let's look at where that started from. In the first case, that was here, expansion at 61.8.